In today's episode of Crypto Over Coffee, we're talking about a new plan for Ethereum to avoid a huge mistake, which could have been a major setback in 2023. But that is not all. We've got news about Theta Network, Coinbase's bold stablecoin claim, a truly terrible FTX recovery plan idea, and more. That said, you know the drill. Grab yourself a coffee, make sure you are subscribed, and stick around for the whole episode that we've got in store today. And please beware of scammers. I won't reach out to you on social media or in the YouTube comments, which are full of spam I just can't keep up with. So last week, actually not last week, but the week before last in Crypto Over Coffee, I did a segment on what I thought was a huge mistake by the Ethereum Foundation and core community to not prioritize the Ethereum staking unlock features in the upcoming Shanghai hard fork event, which was scheduled for 2023, but looked a little dubious in terms of timeline, could have slipped way beyond that. In other words, there are billions of dollars of Ether locked up in stake by those who staked that ETH a long time ago in the beacon chain days. And those people back then were promised that they would be able to withdraw that Ether 6 to 12 months after the merge to proof of stake. Now, at the time of my segment on the matter recently, the Ethereum Improvement Proposal, or EIP, picking process was happening for this Shanghai hard fork, and some of the EIPs that looked to be included in that fork were high effort, high impact bodies of work that would undoubtedly delay the launch of that hard fork and staking withdrawal. That said, both the planned upgrades in Shanghai and the language that was being used by key members of the Ethereum community at that time made it pretty clear that getting the staking unlock feature done quickly and on the original timeline was not as much a priority as we thought. And that's not to say that I thought they had any intention of not doing it at all, but just that 6 to 12 month timeline was no longer relevant, and that just didn't sit right with me. Making people who probably need the money right now to wait another 12 months or more for their staking unlock is unethical, and you just can't trap large volumes of Ether on chain like that without a plan to get it off. Not only that, but there are bankruptcy proceedings for crypto lenders like Celsius that have significant interest in this staked Ether, and many users would also benefit from those proceedings getting cleared up sooner rather than later. Presumably, unlocking the staked Ether might help resolve things there as well. All that being said, my main closing thought in that segment 2 weeks ago was that I wanted the Ethereum Foundation and core community to shift gears and do a shorter term hard fork to get staking unlock done first, and then prioritize a follow-up fork for the additional EIPs, taking as long as they need to get those done right. Now, all this background is important because now it seems like the Ethereum core community has completely changed its tune on this whole thing. And in a meeting to plan the Shanghai hard fork, the community came to consensus on an alternative plan to prioritize the Shanghai hard fork with the staking unlock and a few other features for March 2023. Thank goodness. And then they can move on to the bigger EIPs like EIP 4844 in a fast follow hard fork that will come after Shanghai later in 2023. The always communicative Ethereum core developer Tim Bako tweeted out these updates, and I recommend you follow Tim, by the way. Great for updates on Ethereum. And Tim tweeted an outline of the priority being placed on withdrawals for stakers, which I appreciated. He even mentioned that if any of the other pieces of the Shanghai update are not ready by January, they'll be shifted to that fast follow hard fork so as to not delay staking withdrawal. This is exactly what Ethereum should have done from the very beginning. And I'm really glad they ended up coming to this decision in the end because it looked a little dicey earlier on in this year as to when they were going to deliver on this. It's just the right thing to do, in my opinion, to make good on a major functionality promise that benefits your most loyal community members, people who have put literally their dollars and cents on the line and had their funds locked up for years already to support Ethereum. Of course, I also understand why they were trying to deliver on a big EIP like EIP 4844, which brings proto-dank sharding features for scalability via layer 2 rollups. However, these features can be delivered separately and with focused, careful testing on whatever timeline they need, rather than trying to push them through quicker with a critical staking unlock feature, or worse, what seemed was happening was that they would delay the withdrawal feature to test proto-dank sharding and some of these other things that had a lot more work left to do. Ultimately, I think this is an example of the Ethereum Foundation listening to the community, and that's a really good sign. It's so important for these large community-built entities who implement protocols to listen closely to the broader community of users as they make decisions, because these networks are nothing And I mean nothing without their users and community. So I applaud this change of plan, and more importantly, I think this mitigates what would have been a major mistake for Ethereum going into 2023, which is a critical time for Layer 1 blockchains to cement their place for the future, and for Ethereum to hold on to some of its market share. And speaking of major mistakes, today's 404 Logic Not Found segment covers a notable crypto influencer's idea for an FTX recovery, which Sam Bankman-Fried has publicly agreed with. And it just so happens to be the dumbest possible idea that I could ever think of. So please stick around for that one. It's going to be pretty fun and interesting. And thanks to Onyx Coffee for the coffee today. Not sponsored. In the meantime, I want to give a quick shout out to Theta Network, who finally shipped the long-awaited Theta Metachain. We talked about this a long time ago, but this metachain architecture is the culmination of years of ideation, experience, and effort from the Theta team to bring to market a blockchain network tailor-made for media and entertainment organizations to bring content to their users in a Web3 native environment. The metachain refers to the topological structure of the network itself, which features a Theta main chain, so it's that base layer, and then many branching subchains that can be spun up by different media and entertainment enterprises, Web3 native startups, or pretty much whomever wishes to build a Theta Metachain project or decentralized application. Now, this concept of a multi-tier blockchain network, if you will, is not necessarily new, but what sets Theta's Metachain apart from others who've done something similar is that Theta is in a niche, and that niche drives its design decisions. And that niche is to provide tools for content creation, media, and monetization. And if you refer back to the patents and design documents and blogs that Theta has published over the years religiously regarding things like decentralized content delivery, content-specific token standards, and all kinds of media and content and monetization-like innovations, anyone who's building media or content-focused decentralized applications should definitely evaluate whether a Theta subchain will serve as a perfect application-specific chain for their needs, because it's built and tailor-made for that purpose. Similar to how Cosmos works with the Cosmos SDK, the Theta Metachain will feature a software development kit or SDK that will help developers quickly create a subchain for their needs and then to build on top of it to execute whatever type of idea they have. In 2023, I expect the majority of Theta's efforts to be focused on catalyzing development on the metachain, and I, for one, am very excited to see what type of things get built, both by enterprises and by startups. So expect to see hackathons and grants and all sorts of stuff there in 2023. In other news, Coinbase took what seemed to be a major shot at the $65 billion stablecoin giant Tether by announcing the following statement to its users and followers. Quote, "We believe that USD coin, USDC, is a trusted and reputable stablecoin, so we're making it more frictionless to switch. Starting today, we're waiving fees for global retail customers to convert USDT to USDC." And the subtext there is that USDT is not trusted nor reputable by equivalence, and therefore they want users to freely exchange USDT to USDC. Now, I want to say that I myself have my own doubts about Tether, and I don't have much trust in their attestations of reserves for that huge supply of USD-pegged stablecoin. There is a reason for that as well, because over the years, there's been this precedent of a relative opacity or lack of transparency, at least early on, that caused fear, uncertainty, and doubt about Tether, and the markets have not been able to shake that since. They've not been able to win that trust back. They only have themselves to blame for that. Still, Coinbase's proximity to and involvement with the USDC stablecoin and its issuer Circle is something that makes this statement a bit less about protecting users and maybe more about encouraging the use of USDC. Maybe that's just an assumption or speculation. To be fair, this is within Coinbase's rights to do, but it raises another major question for crypto investors. Who do you trust, or who do you trust the least? Many have deep-rooted distrust for Tether because of the questions as to its accounting and reserves, and many have deep-rooted fear and distrust in USDC due to its regulatory posture. Can funds be frozen or halted at will? What happens in a negative regulatory environment? Who knows? As usual, this public back and forth between Coinbase and Tether and exchange CEOs just illustrates how little the retail investor really knows about what's happening behind the scenes in crypto. And I wouldn't be surprised if there's more to this story that we just don't know yet and that we may never know. Why does Coinbase choose to push users away from USDT so aggressively now of all times? Is it just to protect USDC's market share and win back some of those dollars? Or is there some other reason going on that we don't know about? We may have to wait to find out, and like I said, we may never know. But what I do know, folks, is that it is time for 404 Logic Not Found, a firecracker of a segment on the show where we bring attention to illogical happenings in the crypto space, and today, it's an illogical happening. But if you want to help this show get some attention as well, please hit the like button, get subscribed, follow the podcast, share it with your friends, buy a coffee at your local roaster. All of that is much appreciated. But as I mentioned earlier in the show today, we're talking about the dumbest possible FTX recovery plan that I have heard since the day FTX imploded. And there have been some really stupid ones, but this one wins. I will preface this by saying that I am not attacking the individual who floated this idea. I'm calling out the idea that he tweeted about. So don't take this as a personal attack, because it's not. That said, Ran from Crypto Banter, a show that I've obviously heard of and seen around, but I've never really watched myself, tweeted out an idea for how FTX can recover and make users whole. So all those users who lost their money, how we can make them whole. The tweet stated this, I quote, "Fire up the FTX exchange, issue a new FTT token, distribute the token to creditors and depositors, accrue 100% of profits to token holders. It will be the biggest exchange in the world and users will be made more than whole." Now, there's so much wrong with this that I had to check whether or not this tweet was a parody, but it is in fact legit. So let me start with the first issue that I have with this. There is a $10 billion plus hole, that's billion with a B, in the balance sheet for FTX, a gaping, nearly unfillable hole. And that represents billions of dollars of users' funds that are lost into the ether. The companies are in bankruptcy behind FTX, but before that, the FTX brand had been flushed irreparably down the toilet with every user in crypto after that implosion and the details of it came to light. You can't simply just fire up a new FTX exchange because no one trusts a damn thing that anyone associated with, affiliated with, or around FTX ever does. Do you think anyone will use an exchange that came from FTX? No way. So no, you're not just going to fire up the exchange and make it the biggest exchange in the world without trust, right? Without a good brand. Now, the second glaring problem here is the suggestion that creating another worthless, useless, and frankly offensive exchange token will do anything to help recovery. In fact, the FTT token, and really all exchange tokens like it, are worthless monopoly money trash. And in this case, the FTT token was used as collateral in lending relationships, and that was reportedly a big part of what led to FTX and trading arm Alameda's demise. So why float that as an idea? Let's say, for the sake of argument, that you relaunch FTX, but you won't. You get even 1/100th of the users that had it before. You won't. And then you issue a new FTT token, which you shouldn't. How are you going to build back the exchange and earn trust if you distribute 100% of profits to users? Let me tell you, you won't. The math just does not add up. You hand out FTT tokens to creditors and depositors on day one. The smart ones will dump those tokens to get cents on the dollar for whatever they lost on FTX, and the rest will likely sit waiting for years, hoping for repayment from profits that will likely never come. It will not work. You cannot build a business without trust, let alone a custodial crypto exchange business that lost $10+ billion of user funds and other money in the process of it all. To make this whole saga even more comical, Sam Bankman-Fried, one of the main architects of FTX's demise, replied to Rand's tweet supporting the idea. And if that doesn't tell you what you need to know, I don't even understand. His reply read, "I continue to think that this would be a productive path for parties to explore. I hope, with emphasis on hope, that the teams in place will do so." Are you joking? My mind is actually blown that this is real. At least he just said explore instead of that he thinks they should unequivocally do it, because after even 5 minutes of exploration, any sane manager of the FTX pile of ashes will realize that this plan will only result in a colossal failure. It is a 404 logic not found of epic proportions to believe that anything affiliated with FTX can relaunch as an exchange and win trust with a community of crypto users and even the general public who have been seeing in stereo nothing but the egregious mismanagement of billions of dollars of user funds and other funds for that matter. It's an even worse lapse of logic to believe that issuing a worthless exchange token, the worst of all kinds of useless tokens, and there are many types of useless tokens, by the way, will somehow fix this problem rather than add to a new problem. You cannot fix this with the same instrument that contributed to your demise. Again, I'm going to make clear that despite how passionate I am that this is really stupid, I'm not saying Rand's a bad guy, so don't go and attack him. Please do not. But I vehemently disagree with this idea for FTX's recovery. FTX is dead, it's going to remain so, and it's time people accept that fact and hope that there is some means of recovery for at least cents on the dollar for users. Now, on the topic of trust, one of the things that we've debated both sides of on this channel quite a bit is proof of reserves, which is this emerging trend for crypto exchanges and other depository entities to attest to their holdings of crypto, and in doing so, to provide a barometer for how healthy they are financially, and more importantly, whether they can actually meet withdrawals for user funds. Now, the initial swath of proof of reserves releases from exchanges met a good bit of criticism, and deservedly so, because most of these showed proof of assets that these entities held in their wallets, and we're not even sure if they're all their wallets, but had no context as to the liabilities that entity held, nor the origin of the assets held in balance or for how long they had them. So now, a focus has been placed on a more robust reporting mechanism that gives both proof of reserves, but also proof of liabilities, so that users can evaluate the overall financial health of a depository organization like an exchange. And now, just recently, BitMEX Research, a crypto research firm associated with the BitMEX derivatives trading platform, released a design for privacy-preserving proof of liabilities that protects sensitive information about users and balances and all that kind of thing, but also enables these organizations to attest to their liabilities publicly and for users to verify this data. Now, I've tried to think of an easy way to express the very technical aspects of the data structure behind this scheme in a concise way, but no matter which way I sliced it, to really help you understand it, it would take me 5 to 10 minutes to really explain it, so I'm going to leave that for another video. But what you really need to know about this BitMEX Research plan is that it's a permutation of the traditional Merkle tree data structure method for facilitating these proofs. But in this case, they proposed a randomized splitting of user balances in this data structure, which helps obfuscate individual user balance information when going through and verifying the data using hash-based methods. And I know this may be a bit abstract to imagine, especially if you're not familiar with even the fundamentals of Merkle trees or hashing or any of that, but the key takeaway is that this whole proof of reserves standardization with proof of liabilities is happening in real time. And soon we're going to see the formation of an industry-wide standard for all exchanges and depository organizations to uphold. For now, it's going to be trial and error to find that standard, but just in the wake of FTX and all the stuff that's happened, look how much we've already accomplished in terms of the demand for this type of thing, but also the emergence of standards and better ways to do it. Rapid iteration, really happy to see that. And it's a really good example of how this space is able to self-regulate, albeit in this case way too late. This should have been demanded long time ago, but I think regulators should take a good hard look at this and realize that they could have come up with privacy-preserving, technologically fit rules around reporting for depository institutions in crypto a long time ago, and it would have prevented a lot of these problems. So really interesting thing to think about. Maybe you disagree with me. I'd be interested to hear your thoughts in the comments or on Twitter. You could tweet me at Hashoshi4. That being said, if you have some time to stick around, I do have another video here that I think will be really interesting for you to watch. I'm going to leave it here on the screen. If you're on YouTube, I'll leave it in the description of the podcast version of Crypto Over Coffee. Make sure you are subscribed and you're following the podcast and the YouTube channel, because we've got exclusive content coming to both of these platforms in 2023. Got some good plans for that. Most of all, I want to thank you so much for taking the time to join me on Crypto Over Coffee week in, week out. And for this episode specifically, hope you and your family have a wonderful week ahead. And until next time, cheers.